Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing another company that had earnings earlier today, and that is none other than Goldman Sachs. I believe I have analyzed this company before on my channel, but nonetheless, let's actually see, of course, using book value and tangible book value ratios to see if maybe we might be willing to buy this, seeing that the earnings are actually coming out today, as I said. So with that said, guys, let's get started with this analysis. Now, as you can see, guys, I am pretty much prioritizing banks because, well, I've said it before, banks are the gatekeepers when it comes to the flow of money. So I really want to see how they actually talk about future projections and, of course, their earnings, because doing so, they are going to determine how the economy did in Q2 and essentially how all of the other companies will move throughout the rest of the quarter. So again, I really think that these are the best indicators as to how the economy is doing. That's why I'm essentially prioritizing them. But nonetheless, here we are at the dividend summary. Current dividend yield, guys, of 2.72%, which actually ends up being $2 per share, which is very, very good in my personal opinion. That's actually amazing, actually. Annual dividends payout is actually $8, which is, again, amazing. It is really, really rare to see a company that pays anything above like $1, let alone $2, right? Payout ratio is also looking very, very good because it's about 14.07%, which unfortunately, when it comes to banks, we really can't do a payout ratio in regards to the free cash flow because they don't have a free cash flow. So the best thing we can do is just take a look at the payout ratio in regards to the net income, which is this 14.07% is looking really, really good. The 5-year growth rate on this dividend is also looking amazing at 24.26. However, what isn't looking good though is this dividend growth, which they've only grown it for one consecutive year. However, similar to the other banks that we have analyzed, the reason why it's only 1 or 2 consecutive years is because, well, it's not that they cut it, it's just that they didn't increase it in 2020 because obvious reasons, right? COVID occurred, so they were like, we don't know if we're going to be solvent. We want to keep as much cash on hand just in case, so we're not going to increase the dividend. But as you can see, the next year, 2021, they increased it from $1.25 to $2, which is what it currently is today. So it really is really, really good that they have increased it, even though this dividend growth year only says 1 year. Ex-dividend date passed as of May 31st, payout date was June 29th, and they pay their dividends quarterly. Coming now to the spreadsheet, looking at the book value and tangible book value ratio calculator. Ticker symbol of GS, market cap of $101 billion, PE, guys, of 5.7. So this is already telling me that at a current share price of a whopping $293.87, this might actually be a fairly decent price. Actually, I want to look up, first of all, the price that it was just a couple days ago, because as of Friday the 8th, well, we did have a massive jump, 4.36%. But if we actually take a look on the 5-day, we can see that they went as low as around $278, $288. As you can see over here, the 52-week range is 277. So we were pretty much at 52-week lows just a couple days ago. And unfortunately, it did go up, but we are still significantly way under the 52-week high of $426.16. So this might actually pose a pretty good buy point right now as it stands, even though the price is a little bit overwhelming. Now, in regards to this $8 dividend, if we take a look at the current shares outstanding, which we will do in just a bit, we can actually see that annually they actually pay out roughly $2.87 billion in dividends every single year. Now let's come into some fundamentals, guys, starting of course with the net income. 5 years ago of $4.3 billion to today of $18.7 billion. Now this is an increase of 337%, and the big outlier here is that, well, from 4 years ago to 2 years ago, they were essentially flat. But 2 years ago to 1 year ago, they actually shot up massively, right? From $9.46 billion all the way up to $21.6 billion. Guys, that is absolutely massive. And even this year, they're at $18.7 billion. To be fair though, this year isn't over yet, so this might actually go even higher than what it was last year. So as it stands, I don't necessarily know how they'll do in the future, right? Because this was a very, very big jump. But if things go really bad as everybody's projecting, then be prepared to see a couple lower debt income in the next 2 to 3 years. Now taking a look at the revenue 5 years ago of $32 billion to today, guys, of $53.58 billion, increase of 67%. And we do see something very similar as we just saw with net income. 2 years ago, they were $41.5 billion, and then they shot up to $59 billion. So massive jump, even though within the past 5 years, from what, 5 to 2 years ago, they were roughly at around like the $40 billion mark or so, right? A little bit of an outlier, just like I said, with the net income. We shall see what happens in the next couple of years, especially with, again, the fears of a recession looming. But nonetheless, this is looking very good. Now guys, let's take a look at the shares outstanding. So far, every bank that we have seen, the shares outstanding have been very good, right? The company has been buying back shares, everything's looking great. However, looking at this one, we're kind of beginning to head in a bad direction, right? So 5 years ago, they were at 389 million shares to today, guys, of 359 million shares. That is a decrease in the 5 year of 7.63%. Alright, everything's good here. However, from the previous year to the current year, this is looking at 1 year ago to today, this is an increase of shares of 2.8%. Now 2.8%, guys, this isn't that big of an increase. So I think the reason why they did this is because they figured that the share price was very high. In fact, taking a look at around where this time frame was taken, you can see that the share price was at around $422, right? $422 in November, and $409, $410 at around January of 2022, end of December 2021. So that's essentially why I think they issued shares right here, because they were just like, oh dude, our shares are way overpriced. You know what, let's issue them a little bit. We're good with the dividend, we can cover it, no worries, we're solid. Let's issue shares and let's pay down that debt a little bit. So I think that's the reason why they did it. But nonetheless, be wary of this number. Overall though, they are buying back shares. And now let's actually take a look at the total assets minus the total liabilities. Can they cover their liabilities with their assets if things really go bad, right? This is essentially what this does. We take the assets, we subtract the liabilities, and hope to God that their assets cover their liabilities, and also hope that within the past 5 years, they have been increasing this difference as well. As you can see, they're currently at around $116 billion in this difference, and within the past 5 years, they have been increasing it as well. Average total assets around $1.2 trillion. Average liabilities around $1.1 trillion. And doing this difference, we get around $98.5 billion. And now looking at the valuation for this company using book value per share. Book value, it is by far the best way to figure out if a company is overvalued. If we actually take a look at the balance sheet, we can figure out the book value per share. And as you can see, it is currently at $290.92. An increase of 61% from the 5 year of $181 or so. Now, book value per share takes into account everything that's tangible and non-tangible of the company. However, there is another metric that a lot of people consider to be more accurate than that of the book value, and that is a tangible book value per share. This excludes everything that is not tangible and only takes into account everything that is tangible. And as you can see, currently they're at $272.88, up 60% from the 5 year of $170.58. So what does this actually tell us? Well, it tells us that essentially we are very close to this company being at around fair value. And one way to actually visualize this is through the price divided by the book value per share, as well as the price divided by the current tangible book value per share. This gives us, guys, a ratio that tells us if a company is overpriced, underpriced, or at price. So anything below 1, it is underpriced. Above 1, it is overpriced. And at 1, it is at price. As you can see right here, looking at the price divided by the current book value, well, we're at 1.01. So based off of this is a very good price to buy it at currently, right? We're only a couple dollars away. Now, the price divided by the current tangible book value, we get around 1.08, a little bit more overpriced, but nonetheless, it is looking like it's very, very good still. And again, a couple days ago, we were at around like the $270 mark. So if you had insight and bought this company back then, like a couple days ago, then you probably bought it at price in regards to the price divided by the current tangible book value. You are sitting pretty at that point, right? Now, obviously, hindsight is 2020, right? I didn't make this video. You guys probably who are watching this right now are like, I didn't know. You know, it sucks that unfortunately I didn't make this video in time, I guess you could say, but we shall see what happens next. At least now you know that when a company hits around this 1.00 mark and you own it and you like it based on their fundamentals, right? Then you should 100% be buying more. This is why, guys, I have this calculator available for everybody. I have this one, I have the discounted free cash flow, I have the REIT one, which I just put out a video on Prologis, so hopefully you guys enjoy that. I do have a lot of changes to make with this one because that was the first time I ever did it formally. So, you know, be prepared for this thing to be a lot better in the next coming days. But nonetheless, you guys can still use it as well, guys, as a dividend tracking sheet for anybody to have. All I'm asking for in return, guys, for this free content as well as these calculators and dividend tracking sheet is just help me grow my channel. Thank you so much for everybody who has subscribed, and for all of those of you who haven't subscribed and are probably on the edge, just think about it. You know, it's free at the end of the day. I'm giving you guys free content. All I'm asking is for something free in return. Like, subscribe, comment, tell your friends, and just help me grow. That's about it. Now let's actually take a look at this company in regards to this dividend, because this dividend looks very, very good, right? So let's say that you make the average US income at $68,703. Bringing this to the monthly, guys, this is $5,725, right? If we were to buy 1 month's income of this company at the current share price, what would we get out of it in terms of a dividend? Well, this would buy us around 19.48 shares, which would net us $155.86 in regards to an annual dividend, $38.96 for a quarterly dividend, and almost $13 in monthly dividends. So, you know, this is good. I'm not saying it's not, but you know, we did see Citi. I'm always going to mention Citi because honestly, Citi is one of those that I'm highly consider buying right now. I'm not even joking. Like, Citigroup is one of those companies that I'm highly consider adding to my portfolio. So Citigroup pretty much just showed us that they were paying what, $200+ for a dividend. That's absolutely insane, right? So as it stands, I'm not saying Goldman Sachs is bad, right? The fundamentals are pretty good. That share still standing, though, is a little bit concerning, the fact that they increased it, but I think that they're increasing it because of the fact that they just thought that their share price was overpriced. Aside from that, I think we're fine with it. But even still, this company is only paying around $156 annual in dividends. So depending on what you like, if you're doing this solely for a dividend, you might want to skip it. But if you want to take a look at everything else and the growth that this company might give to your own portfolio, you might consider buying it. Again, not financial advice. All of this is public information. All in all, guys, GS is a company that is interesting. It's could be of good value. I mean, it was a better value just a couple days, just last week, right? But $293, $294. We'll see what happens when they put out earnings. Be on the lookout for a community post on my channel. I usually like to do community posts on companies that I am just about to release a video on their earnings. So be on the lookout for that. And if they end up going bad in their earnings and their stock price falls back down to $270, well, you might consider buying it now that you know all this information. Again, not financial advice, not telling you guys what to do, but you guys should still consider if you like this company. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video.